Welcome back to the Money and Wealth Show. I'm Sterling Fox. Our special guest this week is Portfolio Manager and Financial Advisor Adrian Mastracci, President of KCM Wealth in Vancouver. And he's here with his December dozen list of to-dos for all of us to organize ourselves effectively and for our own tax advantage for the calendar year 2010. Item number 4 has 2 deadlines associated with it. It's called extra RIF payments, and there's a December 1st and December 31st component to this item. Tell us a little bit more about it.
Well, the December 1st is my deadline on, this is for those people that have a RIF and they want an extra payment over and above the minimum that must be taken out. So if you want an extra payment, you have to tell the custodian of your plan that you want that, and you have to give them enough time to do it. So that's why I suggest if you actually give the notice by December 1st, you should be able to get all your payments to you by the end of the month.
Okay, so if otherwise, by law, again, you're only allowed to take out a certain percentage of whatever's inside that RIF per year.
The minimum is a must that you have to take out, and then you can take out everything up to whatever the value of the RIF is. So you can deplete it if you want to. It's not always a good idea, of course.
But this, and if you want to do any adjustments like that, you better get on to your person, your financial person who runs the RIF on your behalf by December 1st in about 10 days, right?
That's right.
Okay.
You want them to get your notice that you want the extra payment, and you may have to sell something to realize the cash and stuff like that in order to make that payment. So just plan early, be ready, don't leave it till December 25th.
All right, as long as we're talking about planning early, number 5 on this 12-item list is a voluntary RIF. Tell us about that.
Well, let's say you're somewhere between age 65 and 70 and you don't have a RIF, but you want some RIF income as part of your overall game plan for whatever reason that you choose, then you have to set up a RIF account for you, transfer some money into it from the RRSP, and take out an amount that you want for your RIF income. So all that takes time, and it takes time to get it set up. It takes time to ask the people that hold the RIF and hold the RRSP to make all the transfers. So again, you just want to do that by December 1st because you need to get the money in your hands no later than December 31st.
Okay. Now, this is an interesting, for example, I don't think a lot of people know that you can actually open up a RIF before the law requires you to on your 71st birthday. That's a bit of a surprise, I must say, from my perspective at least.
You can. Most people don't do it because it probably doesn't really fit the bill.
Okay.
But in essence, if it does, then by all means do it, and just make sure that you've got till December 31st to get all the money in your hands.
Now, as a portfolio manager, would you recommend a voluntary RIF, or would you be looking, or would you advise a person to perhaps look at dividend income from another source and leave the RIF rather in a separate category?
Well, for some people, the RIF income qualifies as pension income.
Aha, okay.
So
so there are tax implications.
There are some implications,
okay.
And if you want to split that with your spouse and so on, then it makes some sense. I wouldn't just pull out the money from the RIF voluntarily, willy-nilly, just because of course, it does impact you down the road. But for those people that have benefit from it, by all means.
All right, number 6 on this list is something most of us know about to one extent or another, the RESP, the Registered Education Savings Plan. And there are tax advantages there too, aren't there?
Well, that's right, there are. You don't get any deductions for the deposits that you make. And for example, this year, to get the maximum grant from the government of $500, you can put in $2,500 of your capital. But what the key is to this particular account is that the income that you generate within the RESP should be taxed in the student's name. So when your son or daughter becomes age 18 or greater and they go to post-secondary university, let's say somewhere like that, then they should be able to pull out the money from the RESP, be taxed at their tax rate, which is hopefully very low or non-existent. Mm-hmm. And therefore, what you have done is you've had all these years, hopefully from the time that the child was born, You've had time to put the money away.
And hopefully grow it
a little bit.
Yeah.
And so when they're ready for the post-secondary part of their education, what it means is that they can pull out money from the RESP, pay tuition and all that sort of stuff that they will incur as an expense, but be taxed in their hands.
Very quickly on the RESP, if you put in a contribution of $2,500, the feds will kick in $500. Does that work once, or if you have more than one child for whose university education you've begun to save, can you do $2,500 per kid and the feds kick in $500 per child?
They do, but they have a maximum, I believe, of $7,200 total that they will kick in per child. And you have an actual maximum of $50,000 you can put into an RESP per child. And if you have a family of 2 or more children who are related, then you can certainly have one RESP for the two or more children.
Okay.
So what happens is, let's say that one of them goes post-secondary and one doesn't, you can actually allocate all of the RESP money to one and not the other.
Item number 7 on this list, and I have to admit, this is brand new to me, is something called an RDSP, a Registered Disability Savings Plan. Tell us about that.
If you're a person that has the disability tax credit available to you from the federal tax department and you're under age 60, your family or you can save up to $200,000 of capital into one of these things. And it's much like the RESP. What happens is you don't pay tax, at least you pay tax on the income that you pull out when that person pulls it out. And hopefully there will be in a lesser tax rate perhaps, or a lower tax rate, that instead of having, let's say, the parents pay the tax on the income, the person who is disabled can pay the tax on the income.
And they will presumably again be at a much lower tax rate.
Presumably, that's the key to the whole thing.
Okay.
And you don't get a deduction for the amount that you put into the RDSP, but you do get the taxation waived until it is actually, the money is pulled out in tax in the person's hands.
Any federal contribution dollars to an RDSP?
Yes, there's a bond and stuff like that. It looks something like an RESP, so there's a contribution from the federal department that comes to one of these. But it is not that well known. If anybody has the federal disability tax credit available, look into this.
All right, our special guest this week on the Money and Wealth Show, helping us all become a little better organized and maybe even save a buck or two from the tax department before the end of this calendar year, is Adrian Mastracci from KCM Wealth Management in Vancouver. Lots more to come. Stay with us.
Hi, I'm Larry Ray, President and CEO of Gold Ray Resources Corp. Our major project is in Shandong Province, China. It's a gold project with a 43101 resource. We're currently negotiating a $16.5 million US loan to take it into production at 1,500 tons per day. For more information, go to goldray.com or phone me directly at 604-531-9639.